If your parent is struggling financially and you're worried about them long-term paying necessities like medical bills or everyday expenses, or even making sure they live in their home that they're in today, I'm sure you've run across the term reverse mortgage. But is it a solution or is it another risk? Let's walk through it honestly, clearly, and from a family first perspective. I'm Josh, and I specialize in educating families about the benefits of a reverse mortgage without the jargon or pressury sales tactics. I believe so much in these programs that my own grandparents opened up a reverse mortgage based on my suggestion, and it wasn't even with me. Let's talk about what a reverse mortgage is, how it works, and what you need to know as a family prior to making this decision. What is a reverse mortgage without the fluff? A reverse mortgage is a loan for homeowners 62 and older. It lets them access their home's equity in cash without having to make any monthly mortgage payment, all while living in the home. They still own the home and they are still responsible for property taxes, homeowners insurance, and any HOA dues that are applicable. The loan is paid back later, and usually when that family member passes and the heirs take responsibility of the property and they either sell or refinance. A lot of the times when I'm working with individuals getting a reverse mortgage, I'm speaking to a lot of their family members who have major concerns, and rightfully so. The four main questions I hear are: 1, will my parents lose the house? The short answer to this is no. As long as they maintain the property by paying the property taxes, homeowners insurance, and any HOAs, making sure the property's in good shape, they will not lose the home. They still retain their name on title and the deed, and the house is theirs. Number 2, does the bank own the home? No. Again, your family member retains title, retains their name on the deed. It is their house to do whatever they wish. Number 3, what about our inheritance? The loan balance on a reverse mortgage grows over time, which eats into the equity that heirs are going to receive. A lot of the time when I'm speaking to families, they don't care about the equity. They have their own lives, their own homes that they're dealing with, and they just want their family members, their parents, their grandparents to live a good life in their retirement ages and beyond. And so yes, the equity does shrink over time, but does that really matter? Number 4, what happens when the family passes away? Once the family member passes away, the family or the heirs are then responsible for the property. Most of the time they end up selling the property and use those proceeds to pay off the reverse mortgage, and anything that's left over is theirs to do whatever they want. You do have the option to also refinance out of the reverse mortgage and pay back whatever is owed. So as you can see, there's a few different options. When is a reverse mortgage a smart move? Here are some scenarios of when a reverse mortgage can really help. Your parents want to age in the house that they're in, but money is tight. A reverse mortgage is a good option to tap into that equity for additional capital. They have a paid off or nearly paid off house with plenty of equity to tap into. They want to avoid dipping into any retirement accounts or selling the house prematurely. There are many benefits to a reverse mortgage, and some scenarios are different from others, but as you can see, there are plenty of scenarios where it makes sense. Look, a reverse mortgage isn't for everybody, but it is for some. For the right family at the right time, it can absolutely be life-changing. If you're exploring this option for yourself or a loved one, reach out. Happy to walk through it with you and your family, zero pressure. If this video is helpful, please like and subscribe. Comment your questions down below. Thanks so much for watching, guys. I'll catch you on the next one.